One of the biggest mistakes investors make is trying to time the market. Many believe that they can predict when stock prices will rise or fall, allowing them to buy low and sell high. However, market timing is notoriously difficult, even for professionals. The stock market is influenced by a vast array of unpredictable factors, including economic indicators, geopolitical events, and investor sentiment. Attempting to time the market often leads to missed opportunities where investors sell prematurely or wait too long to re-enter. The better approach is to adopt a long-term strategy that focuses on consistent investments and diversification rather than short-term speculation. Even professional analysts and experienced investors struggle to foresee economic shifts, unexpected events, and investor sentiment. When individuals attempt to buy at market lows and sell at highs, they often end up doing the opposite, selling when prices drop out of fear and buying when prices rise due to optimism. This behavior results in losses rather than gains. Studies have shown that being out of the market during just a handful of its best-performing days can drastically reduce long-term returns. This is because markets tend to recover quickly after downturns, and those who remain invested during volatile periods often benefit from strong rebounds. Additionally, frequent buying and selling lead to higher transaction costs, including brokerage fees and taxes on gains. Over time, these expenses eat into returns, making it harder to achieve financial goals. Instead of trying to time the market, investors should adopt a disciplined approach with consistent investments using dollar-cost averaging, DCA, diversified portfolios, and a focus on long-term growth. Another common mistake is believing that this time is different. Investors frequently rationalize excessive optimism or pessimism by assuming that current conditions are unique and will not follow historical trends. For example, during market booms, investors may argue that valuations can keep rising indefinitely, ignoring historical market cycles. Conversely, during downturns, they may believe that a recovery is unlikely. This thinking can lead to extreme investment decisions, such as going all in during market highs or selling off assets in a panic during downturns. While every market cycle has unique aspects, history has shown that markets tend to revert to long-term trends, making patience and discipline essential. Holding too many assets in short-term investments is another common misstep. While short-term investments, such as cash or money market funds, can provide liquidity and stability, over-relying on them can limit long-term growth potential. Many investors keep a large portion of their portfolio in cash because they fear volatility, but this often leads to lower returns. Inflation erodes the value of cash over time, making it crucial for investors to balance their holdings with assets that generate higher returns, such as stocks, bonds, or real estate. Investors focusing on short-term assets also miss out on the opportunity to hedge against inflation. Especially at times like now, short-term assets often yield lower returns, which might not outpace inflation, eroding the purchasing power of the invested capital. Conversely, long-term investments like stocks or property typically provide returns that exceed inflation, preserving and even enhancing an investor's real wealth. Additionally, short-term asset holders miss the potential advantages of market growth cycles. Long-term investors benefit from staying invested during market fluctuations, capturing recovery and growth phases. By prioritizing short-term assets, investors may inadvertently attempt to time the market, which can lead to suboptimal decision-making and missed opportunities for higher returns during rebounds. A well-diversified portfolio can help mitigate risk while still allowing for wealth accumulation. Many investors also spend too much time worrying about news headlines. The financial media is filled with sensational stories that can cause unnecessary anxiety. Whether it's warnings of an impending recession, geopolitical tensions, or company-specific scandals, investors may feel compelled to react impulsively to the latest news. However, making investment decisions based on headlines often leads to poor timing and increased emotional trading. Instead, investors should focus on fundamental analysis and long-term trends rather than reacting to short-term noise. A solid investment strategy should be resilient enough to withstand market fluctuations without requiring constant adjustments based on news cycles. Performing too much analysis without execution is another costly mistake. Some investors fall into the trap of endlessly researching stocks, economic data, and market conditions without ever taking action. While due diligence is important, excessive analysis can lead to paralysis by analysis, where investors hesitate to make decisions because they fear making the wrong choice. The key to successful investing is balancing research with execution. A well-thought-out plan should include investment goals, risk tolerance, and asset allocation strategies. Investors must recognize that no investment is without risk, but sitting on the sidelines indefinitely can result in missed opportunities. The reality is that investing is a risk exercise. Even the most experienced investors can only work with best estimates after accepting their risk appetite. One thing has been true time and again historically is that over long periods, investors have done better by being in the market than being out of the market, which means a simple strategy as dollar-cost averaging will provide exposure to gains and minimize your downside over a long period of time. Trying to predict the future is another error that investors frequently make. While forecasting market trends and economic conditions can be valuable, no one has a crystal ball that can accurately predict the future. Investors who rely on predictions, whether from analysts, media outlets, or personal intuition, often find themselves making poor decisions. Market movements are influenced by countless variables, many of which are unforeseeable. A better approach is to prepare for different scenarios, rather than attempting to predict specific outcomes. Diversification, risk management, and regular portfolio reviews are more effective than relying on speculative predictions. The most important is probably failing to account for taxes that can significantly impact investment returns. Many investors focus solely on the potential gains of their investments without considering how taxes will affect their net returns. For example, frequent trading can lead to higher capital gains taxes, and failing to optimize tax-advantaged accounts can result in unnecessary expenses. Strategic tax planning can help investors minimize their tax liabilities and maximize their long-term returns. Utilizing tax-efficient investment vehicles, understanding the implications of selling assets, and taking advantage of deductions are all important components of effective tax management. For tax planning, we suggest that you consult with your CPA. The main message here is that you understand how any investment will affect your income, because every year we have to pay the United States Internal Revenue Services, Uncle Sam, its dues. If your investment is not well structured, you may end up paying upwards of 40% on your gains, if not more, when you add both federal and local taxes. By recognizing these 7 mistakes and implementing strategies to avoid them, investors can improve their decision-making and build a stronger financial future. Investing requires discipline, patience, and a focus on long-term growth rather than short-term reactions. Those who learn from past missteps and adopt a well-rounded approach to portfolio management are better positioned for sustained success. Check out our other videos to learn more about how to become financially free.